So let's look at those banks that have already given us, they've already issued again a profit warning. In that list of the ones we know so far, we don't have I&M, we don't have Cooperative Bank, we don't have NCBA. As some of those, and APSA as well, that have already issued a profit warning. But George, here you are saying that, well, you don't expect that 2021 is going to be a very good year for the banking industry. But let's look at exactly the other reports that are sort of giving us what the general sentiment and feeling is from some of these banks. Equity Group, we do know, extended a 3-year moratorium again, George, to some sects of its loan book. Meaning that if you take by what the regulator gave us 1 year plus 3 years on top of what equity is doing right now, that's going to be 4 years. But here we are saying, George, that 2021 might be a good year for the banking industry. Are we being too optimistic?
Elijah, I think we'll have to look at 2021 vis-a-vis the background.
Yes.
Or where the industry is coming from.
Yes.
We are coming from a very depressed financial year, that is 2020. So if, in fact, for me, Elijah, or for any analyst, any bank that will record a reduction in profits of not more than 30% is a good performer, given the circumstances that they traded in. Remember, I told you, Elijah, that most companies, and you know, all these companies bank with one bank or the other. Most companies were not in operation between the month of March all the way to the month of December last year, and therefore they were not only able to pay their loans, they were not able to finance both principal and interest if they had facilities with the banking industry, save for a few companies that operated that made some business in 2020. So I was looking at a company or any counter or any corporate that is able to record a reduction of profits of not more than 30% is a good performer given the circumstances that we had in 2020. Come 2021, Elijah, things have started looking up. Of course, with the advent of the vaccine, things have started looking up. And if you look around you find that most companies at least are back into operation, with the exemption of I think companies the tourism industry. But if you look at the education industry that had stalled completely, they're back into operation. If you look at manufacturing, they're back into operation. So that is why I'm saying that 2021 probably is going to be a better year if you compare it with 2020. The likes of Equity, what they've done is that they have extended a moratorium on capital repayment,
yes,
but not interest repayment.
Yes.
That is to say that if you have a loan with, say, Equity Bank, you are obligated to pay the interest element of that loan, but the capital repayment is now staggered to 2 or 3 years. So that means that that company will be able to recover its revenue for that particular facility, even if they have given that moratorium. Those are the metrics. So those are the dynamics that we have in that industry. It will be interesting to see how companies in that space are going to report their results within this March. I pick it from what my brother said, that most of them would have reported their results by the second week of this month. But we've not seen that, even with the big players like Cooperative Bank, Equity Bank. But we expect to start seeing those results trickling in from next week, going to the 4th week of this month. So I'll be really interested to see, one, the percentage drop in their profit after tax, and then 2, their provision to bad and doubtful debt. That will give you an indication of where they will be in 2021. If there's a huge provision for bad and doubtful debt in 2020, then you expect that will be written back into their profits come 2021, because some of those loans were suspended, but not that they were bad. So this industry, Elijah, I think personally, from where I sit from, I think I'm still hopeful that this is an industry that will bounce back very fast. And remember, the banking industry is the heartbeat of the economy.
Yes.
If the banking industry is performing, Elijah, then you expect the other sectors in the economy to also perform. So Stanbic has led the way. They have shown us what they have done in 2020. They have shown us that their PAT went down, but by 19%, which to me I think is a good performance given the circumstances that we had in 2020. So between now and end of March, Elijah, will be an interesting period to watch some of these players reporting their profits. The tier 2 and tier 3 banks, Elijah, some of them are likely to report losses, so to speak,
yes,
and might be not so small losses, but substantial losses, and that is expected, given that they're more risky, or they don't have the capacity to absorb some of those shocks that came in with the 2020. But a larger percentage of tier 1 banks will report a reduction in profit, but at least they'll still report some profits back to their shareholders, Elijah.
Pretty much. Paul, that was actually my next question that I have for you. It's a good thing that George is actually intimated to it. When we are talking about the general performance of the banking industry in 2020, should we also look at the dire effects, if there are going to be any, for tier 2 and tier 3 banks before we say, well, on an aggregate, we pulled out as a banking sector, as a banking industry within the effects of the COVID-19 pandemic? Should that be how we summarize the performance? Or we could focus on tier 1 and say, well, I mean, even the regulator doesn't want these other smaller banks to operate within the economy.
It's going to be a very difficult time for tier 3s and some of the tier 2s and okay, maybe not tier 1s. They have sufficient capital to absorb the shocks.
Yes.
But for sure, I'm sure the central bank will encourage mergers in tier 3, which they have done. They'll encourage takeovers. They'll encourage all these things before a lot of problems come in. We saw when we saw these banks which collapsed, which were taken over, statutory takeovers recently. When that happened, we saw a lot of movement of deposits from tier 3s and tier 2s into tier 1s.
Yes,
we saw a lot of that when those banks were taken over. This is also going to affect the tier 3s and some of the tier 2s, because we will see because once a bank starts declaring a loss or hardly any profit, you'll find that if there are other banks which are more resilient, unless you have something holding you back into that bank, a lot of people will move. So I think we will definitely see a lot of action within the banking industry, but it will depend on how the size of the bank, which tier are you in. So as George alluded, you'll see some tier 3s, some movement in the tier 3s for sure. That's my view.
Yes, Paul, clear for us this conversation like this. I mean, the biggest regulatory response that we saw from the regulator was, reducing the cash reserve ratio. Has it had any impact, if any? I mean, because we don't know what it did was release the amount of money that banks could lend within the economy, but the economy was not performing during that time. How can we relate that to the results of what we are seeing again from banks like Stanbic already giving us their results now? Has it had any effect?
Yeah, for sure. You'd find that if the CRR was not reduced by that 1%,
yes,
basically what would have happened is that the 260 billion that Stanbic has in its deposits,
yes,
5.25 would be held in a non-interest earning account in central bank. But this has been reduced, and has been reduced by 1%, releasing about 2.6 billion for Stanbic. So that release of 2.6 billion, even at least putting it in treasury bills, would earn some income. So I'm sure it has done some good to the bottom line of Stanbic. If you look at the industry as a whole, you'll find that total banking deposits could be in the region of about 3 billion. So a 1% reduction in the CRR would release about 32 billion. to the banks, which would actually, at worst, cushion the liquidity ratios, because a lot of banks would actually have issues with the liquidity. And the second is that with additional free cash, you definitely get more interest, more interest income for sure. Yeah.
Pretty much. Paul, let me thank you very much for joining us this morning for this conversation about, well, the state of the banking industry in the country as we continue to receive those results from the banks themselves.
Thank you, Elijah.
All right, we move on with George. Two reports, well, that has been released by the National Treasury that indicates that the government's unpaid bills to suppliers and contractors sharply rose to 322.5 billion shillings by the end of December 2020 from 89.9 billion by the end of December 2019, representing a 259% increase. State-owned corporations contributed to the largest share at 85% of the pending bills to suppliers and contractors, or in monetary form, 274.3 billion shillings, with government ministries and state departments owed 48.2 billion shillings, equivalent to 15% of the pending bills. At the end of last year, collections were heavily affected by the coronavirus pandemic, which saw the tax run miss collections by 109 billion shillings, further highlighting why the pending bills shot up. Now, government expenditure and net lending for the period ending 31st December 2020 stood at 1.215 trillion, which was 44 billion below the targeted expenditure of 1.259 trillion. Good. Just before we cross over to George, let's cross over and see exactly how the government expenditure has been this morning as we really look to interpret why the pending bills have shot within the coronavirus pandemic. Rich, if you could actually show us that data right now. Good. National government expenditure, you can see all the way from 2017 to 2018 up to where we are right now, 2019-2020, has been on an increasing, albeit dropping shortly again. But now, question is, why do we continue to have that pending bills despite the Treasury being amongst those ones who are saying there is no reason for you to continue having pending bills if indeed we're releasing that money? George, could we say that this is solely attributable to the effects of the coronavirus pandemic?
I don't think that is the case, Elijah.
Yes.
Or if it were the case, then it is a mixture of many reasons. Remember, in government cycles or in treasury, they plan for the future. They do their budgets 1 year in advance. Remember the issue of this spending is something that the government had discussed in 2018. They discussed it again in 2019, and even there's a time that a legislation was passed that government should not hold suppliers' money for more than 3 months. I think that went through Parliament. I'm not sure if it was assented to by the president, but I think there's a time the president pronounced himself and instructed ministries, instructed county governments, and instructed state corporations that they need to start clearing the pending bills. That is a problem, Elijah. That government seems to be speaking from two sides of their mouth. One, they tell their agencies or even the county governments that you need to clear your pending bills within a specific period of time. And then at the end of the year, when you analyze our pending bills budget, then you realize that most of the defaulters or most of those agencies that still hold the largest chunks of pending bills are actually state corporations, which are under ministries, which again are under the report directly to the executive. That is where I have a problem. That sometimes we have a policy that is not followed through with action. But that notwithstanding, let me come back to probably the reason why we have those that sorry state. Remember last year, Elijah, the government through economic stimulus 1, economic stimulus 2, had given a lot of tax breaks to the economy. One was through the reduction of the corporation tax,
Yes.
through the reduction of pay as you earn, and through the reduction of value-added tax. So meaning the amount of money that government collected within that period between March and December 2020 actually went down significantly, because remember, those three taxes are the biggest contributor to the revenue in the economy. But that notwithstanding, Elijah, remember it's the same last year that we had a problem with government not being able to finance its borrowing. It was not able to finance, I think, 3, 4, 5 categories in its debt portfolio. So I think we had a serious problem with the fiscal management in 2020 that has to be remedied in 2021. Remember that COVID-19 came on the hit on the heels of Ukur Yatani just getting into treasury and inheriting the mess that was therein. But that should not be an excuse for the sorry performance of what we are seeing today. So I think Treasury should put its act together and start sorting these things one after the other. One, they should start looking at their debt portfolio and then look at their pending bills and ensure that these things are sorted out. If they're not sorted out now, Elijah, then I bet you that in 2 to 3 or 4 years down the line, in fact, let me not even say 4 years, between 1 to 2 years down the line, you might have a government shutdown, meaning the government will not be able to finance its operation. The way suppliers work is that if I'm not paid for what I've supplied today, then I'm not able to supply the next consignment. Yes. Because some of these supplies are through borrowed funds. If I borrowed from Bank A and I'm not able to repay that loan, I am not able to get money to resupply that consignment again to government. So this is something that government must really sit down and sort out. If they don't sort this out, then you might experience a government shutdown in 1 or 2 years down the line, Elijah.
Pretty much, George. Thank you very much for taking your time this morning to speak to us here at Metropole Television. Always lovely to speak to you, sir. Right, on that note, we come to the end of Metropole Business AM. My name is Simba Elijah Charles Kiaga. Good morning.